Hello everyone, so we are studying the research analyst series of NISM. So in previous videos we were studying the depository receipts. So let's continue. So some of the country where specific depository receipts include, so there are different countries where this is happening. So first one is American depository receipts, that is ADRs. So these depository receipts issued and traded in the USA that are issued by non-US company, that is ADRs. ADRs are one of the most popular depository receipts, and many companies across the world have issued ADRs. Some of the Indian companies that have issued ADR include Infosys, Wipro, ICICI Bank, and HDFC Bank. The American exchange have allowed ADR since the early part of 20th century, and thus it is one of the most evolved markets. Indian Depository Receipts, that is IDR. So DR issued and traded in the Indian market by a non-Indian company is referred as IDR. Depository receipts of Standard Chartered Bank are traded in the Indian stock market in the form of IDR. Hong Kong Depository Receipts, that is HKDR. In the same lines of the above two, HKDRs refers to depository receipts issued by a non-Hong Kong company that are traded in the Hong Kong market. Fourth one is Global Depository Receipts, that is GDRs. So these refer to depository receipts that are allowed to be traded in more than one country. Typically, GDRs are preferred to be issued in the European Union member states as commonality of the regulations makes it easy for the issuing companies to comply with regulation across the region. The company whose shares are traded in as DRs gets a wider investor base from the international markets. Investors in international markets get to invest in shares of the company that they may have otherwise have been unable to do because of several restrictions or administrative issues. Investors get to invest in international stocks through domestic exchanges with their existing brokers and local currency. Holding DRs give investors the right to dividends and capital appreciation from the underlying shares, but no voting rights. However, issue of voting rights to DR holders is under consideration of SEBI at present. Next term we have is foreign currency convertible bonds, that is FCCBs. So FCCBs are or foreign currency convertible bonds are foreign currency, usually dollar, denominated convertible debt papers issued by companies in international markets. These instruments are to be understood the way convertibles are, with only difference that they are generally optionally convertible and issued offshore in different denomination under guidelines as defined by Reserve Bank of India, that is RBI, from time to time. The payment of interest and repayment of principal, if happens on these bonds, is in foreign currency. However, once conversion of instrument happens in equity, dividend is paid in Indian rupees with conversion obligation, where currency risk is involved, lying with the investors. FCCBs are regulated by RBI notifications under the Foreign Exchange Management Act, that is also called FIMA. The issue of foreign currency convertible bonds and ordinary shares through depository receipt mechanism 1993 lays down the guidelines for such issues. Next term we have is equity linked debentures, or ELDs. So ELDs are floating rate debt instruments whose interest is based on the returns of the underlying equity asset, such as Nifty 50, S&P, Sensex, individual stocks, or any customized basket of individual stocks. The issuer of bond invests a predetermined part of the principal amount collected in fixed income securities like bonds, which provide principal protection while the balance is used to buy options, which provide the exposure to returns of equity. Thus, these instruments are generally structured in a way to give full capital protection with a provision for equity participation to the investors. Capital protection should not be read as non-existence of credit risk of default by issuer. These instruments still carry credit risk and accordingly rated by credit rating agencies. The next term we have is commodity linked debentures, also called CLDs. Just like ALDs, CLDs are floating rate debt instrument whose interest is based on the returns of the underlying commodity asset. While the returns can be linked to any commodity, most of these papers globally are linked to precious metals like gold and silver. Like ELDs, the advantages of CLDs is that they provide the investor an opportunity to earn return from the commodity markets while protecting their initial capital. The next term we have is mortgage-backed securities (MBS) and asset-backed securities, that is ABS. So MBS and ABS are debt instruments issued by institutions against the receivables and cash flows from the financial assets such as home loans, auto loans, rent receivable, credit card receivables, and others. The cash flows occurring from these assets are used to meet the interest and principal repayment obligations on the bonds issued. The issuer is able to create liquidity in an otherwise illiquid asset by securitizing them. The instruments are credit rated and may be listed on stock exchanges. Financial innovation is a continuous process, and new products keep hitting financial markets on a day-to-day basis. The next term we have is REITs or InvITs. So we will cover these two ones in the next video. That's it for now. Thank you.